The auto market is facing something we haven't seen in decades. Dealerships are drowning in inventory, slashing prices to record lows, and yet buyers are still staying away. The lots are packed, brand new trucks and SUVs are sitting for months without moving, and salespeople are desperate to make deals. But how did we get here? The crisis didn't happen overnight. It started when automakers overproduced vehicles after the pandemic supply shortages, betting big on a non-stop wave of demand. At the same time, rising interest rates and sky-high loan costs pushed ordinary buyers out of the market. The result? Dealers are now stuck with cars they can't sell. Manufacturers are piling on incentives, and the numbers just aren't adding up. This crisis is shaking the entire industry. For buyers, it sounds like an opportunity. Discounts, rebates, and financing offers that were unthinkable just a few years ago. But there's another side of the story. Automakers are taking a massive hit on profits, which could mean layoffs, factory slowdowns, or even canceled models. The used car market is also feeling the pressure as prices collapse, alongside new inventory. Dealerships, many of which rely on quick turnover and strong financing, are now facing cash flow problems that threaten their very survival. So the big question is, should buyers step in right now? On the surface, the deals look incredible. You can find trucks and SUVs selling for tens of thousands below sticker price, and leasing deals are finally becoming attractive again. But it's not that simple. Interest rates are still high, banks are tightening lending standards, and some experts warn that prices may continue to fall as dealerships and automakers become more desperate. That means a buyer today might save thousands, but waiting a little longer could mean even deeper discounts. That uncertainty is exactly what's making this market so unusual. In normal times, when prices dip, buyers rush in. But today, hesitation is everywhere. Consumers don't trust the market. Many are worried about job security, inflation, and the possibility that cars will keep getting cheaper if they just hold off a little longer. Dealerships, on the other hand, are panicking because every month those unsold vehicles sit on the lot, they lose value. Cars are depreciating before they even find an owner, and that's forcing dealers to slash prices even more aggressively. Automakers are caught in the middle of this storm. They've invested billions into production, supply chains, and new model launches, but now they're watching sales stagnate. To move metal, they're reviving strategies we haven't seen since the 2008 financial crash. Massive rebates, zero-down leases, and cashback offers. Yet the fear is that these deep discounts could cheapen their brands long-term. If buyers expect constant markdowns, it makes full-price sales almost impossible in the future. Meanwhile, the used market is unraveling alongside the new. Vehicles that were selling above MSRP during the shortage are now plummeting in value. Families who bought during the peak are suddenly finding themselves underwater on their loans, owing more than their car is worth. That creates even more hesitation for new buyers, because nobody wants to repeat the same mistake. And here's the real kicker. Dealerships are not only battling slow sales, but also rising operating costs. Interest on floor plan financing, the loans dealers use to stock their inventory, is eating into profits like never before. Every unsold SUV is costing them money daily, and for smaller dealerships, this could be the breaking point. Some are already quietly shutting down, consolidating, or being forced to sell their franchises. If dealerships keep collapsing, the ripple effects will be enormous. These aren't just car lots, they're community anchors. In small towns across America, dealerships employ sales staff, mechanics, finance workers, and service technicians. When those doors shut, local jobs disappear, tax revenue shrinks, and the town loses one of its biggest businesses. It's not just about cars, it's about the entire local economy. And when enough dealerships fail, it also means fewer options for buyers, less competition, and potentially higher repair costs down the line because fewer certified service centers remain open. Automakers are already scrambling to respond. Some are quietly shifting toward direct-to-consumer models, similar to Tesla, where buyers order online and take delivery at a central hub. This could cut out traditional dealers entirely, but making that transition isn't easy. Legacy automakers have deep, decades-old contracts with dealership networks, and breaking those ties could trigger lawsuits and massive political battles. Still, if the crisis deepens, manufacturers may see no other choice than to push toward a new sales system, leaner, more digital, and less dependent on local franchises. For buyers, that potential shift raises more questions. On one hand, the collapse of dealerships might force even steeper discounts as businesses try to survive. On the other, if automakers take more control, they may tighten pricing and reduce negotiating power, eliminating the huge deals buyers are enjoying right now. That's why timing is so critical. The window of massive discounts may be closing faster than people think if this restructuring accelerates. At the same time, automakers are weighing whether to cut production drastically. Too many vehicles are already clogging lots, and the last thing they want is to flood the market further. But cutting production has its own consequences: factory slowdowns, layoffs, and ripple effects across suppliers, parts manufacturers, and shipping companies. Every step in the chain feels the pressure, and that could end up reshaping the entire auto industry workforce in the next year. Looking ahead, the long-term outcome could redefine the way Americans buy cars forever. If dealerships continue to crumble under financial pressure, the traditional car buying experience, walking onto a lot, negotiating with a salesperson, driving off the same day, may slowly disappear. Instead, the future might look more like online shopping, buyers customizing their vehicle on a website, waiting weeks or months for delivery, and never setting foot in a dealership at all. Automakers love this idea because it gives them tighter control over pricing, inventory, and branding. But for buyers, it could mean losing the bargaining power that comes with face-to-face negotiations. This shift could also change the types of vehicles offered. If sales remain sluggish, automakers may abandon slower-selling models and focus only on what moves: popular pickups, mid-size SUVs, and a handful of electric vehicles. That means less variety for consumers, fewer niche models, and possibly the disappearance of affordable entry-level cars. We've already seen compact sedans vanish from showrooms over the last decade, and this crisis could accelerate that trend. The industry may simply decide it's not worth building cars that don't generate big profit margins. And here's where the stakes get even higher. The buyer psychology that's gripping the market right now could become permanent. Once consumers get used to waiting for discounts, once they realize that cars can lose thousands of dollars in value overnight, trust in automakers and dealerships will never fully return. The collapse of confidence is often harder to fix than the collapse of prices. If buyers believe prices will keep dropping, they'll delay purchases indefinitely, and that could lock the industry into a vicious cycle of oversupply, discounts, and financial losses. Meanwhile, governments and policymakers are paying close attention. The auto industry isn't just another business. It's tied directly to the health of the entire economy. Millions of jobs, billions in tax revenue, and even national trade balances depend on stable car sales. If dealerships continue to fail and factories slow down, pressure may mount for bailouts, incentives, or intervention, much like we saw during the 2008 crisis. But this time, the challenge is different. It's not just a credit crunch, it's a buyer confidence collapse. For buyers, the dilemma is more complex than it looks on the surface. On one side, the deals are undeniably tempting: record-high rebates, thousands off MSRP, and financing incentives that would have been impossible just 2 years ago. For someone who needs a car right now, walking away with a brand new vehicle at a steep discount feels like winning. But the other side of the coin is risky. With inventory stacking up and dealerships desperate, prices could fall even further in the coming months. That means today's deal might not look so sweet 6 months from now if the same vehicle is suddenly thousands cheaper. Interest rates make the equation even tougher. Even if the sticker price is lower, many buyers are shocked when they see their monthly payments. With rates hovering at multi-decade highs, financing a new vehicle can still feel crushing, especially when combined with insurance premiums that are climbing across the board. Some experts argue that waiting until rates drop, if they do, could save buyers far more over the life of the loan than grabbing a discounted car today. Then there's the used market to consider. Prices on used cars are tumbling alongside new inventory, and many analysts expect that fall to continue. For budget-conscious buyers, holding off might mean scoring a nearly new vehicle for a fraction of the price once the market bottoms out. But again, no one knows exactly when that bottom will be. The fear of buying too soon and losing thousands in depreciation is keeping many consumers on the sidelines, adding more fuel to the industry's crisis. And while buyers weigh all of this, automakers and dealerships are ramping up marketing campaigns, trying to convince the public that now is the time. You'll see flashy ads with huge discounts, zero-down offers, and lease deals designed to look irresistible. But the truth is, these offers exist because dealers are desperate. That desperation itself is a signal that the market is still unstable, and the pressure on buyers to act fast may actually be a sign to pause and think twice. This standoff between buyers and dealerships has turned into a kind of psychological chess match. Buyers know dealerships are bleeding cash with every passing week, and that knowledge gives them leverage. The longer they wait, the better the deals seem to get. On the other hand, dealerships are banking on fatigue, hoping that eventually buyers will cave to necessity, whether it's a family needing a new SUV, a contractor needing a truck, or a commuter whose old car finally gives out. It's a waiting game, and both sides are digging in. Dealerships are also using subtle tactics to keep buyers from holding back too long. Some are pushing the narrative that discounts won't last, or that inventories of popular models are running out. But when you drive past their lots and see rows of unsold vehicles stretching as far as the eye can see, the message feels hollow. Buyers are skeptical, and that skepticism is reinforced every time another headline about price cuts hits the news. At the same time, the automakers behind the scenes are quietly applying pressure of their own. They don't want their brands to become synonymous with endless discounts. It cheapens the image and destroys profit margins. Some are experimenting with production slowdowns, hoping to choke off supply and restore balance. Others are doubling down on incentives, trying to spark momentum by making certain trims or models almost impossible to resist. It's a tug of war, and the outcome depends on who blinks first: the consumers holding on to their cash or the automakers bleeding red ink. The problem is, both sides are running out of patience. Buyers are stretching the life of their current vehicles longer than ever, but at some point, mechanical failures force action. Dealers, meanwhile, are seeing floor plan financing costs balloon, making each unsold vehicle a liability they can't afford to keep much longer. This tension is building like a pressure cooker, and when it finally blows, the entire market could shift overnight. That breaking point could come faster than anyone expects. All it takes is one major automaker announcing a drastic move, whether it's a wave of factory shutdowns, an unprecedented round of layoffs, or a blowout nationwide clearance event, to trigger a chain reaction. If a brand like Ford, GM, or Toyota suddenly slashes prices across the board, every competitor will be forced to follow. Dealers sitting on bloated inventories will have no choice but to cut even deeper, and that could send shockwaves through both the new and used markets. Overnight, the value of cars people already own could drop thousands of dollars, creating an even bigger crisis of confidence. But the breaking point might also come from the buyer side. If enough consumers suddenly flood the market to scoop up the steepest discounts, inventories could clear out quickly, restoring some balance for dealerships. The problem is that surge of buyers may not happen in a coordinated way. Some will jump early and regret it when prices fall further. Others will wait too long and find the exact vehicle they wanted is gone. Either way, the chaos leaves both buyers and sellers guessing, fueling the uncertainty that defines this entire crisis. And there's another looming factor: banks. Financing is the lifeblood of the auto industry, and lenders are growing cautious. With more borrowers defaulting on high-interest auto loans and used cars losing value faster than expected, banks are tightening standards. That means even if a buyer wants to take advantage of massive discounts, they might struggle to get approved. If credit availability contracts further, it could choke off demand entirely, pushing dealerships closer to collapse no matter how low prices go. Behind all of this lies a dangerous truth. The auto industry is balancing on a razor's edge. One wrong move, one miscalculation, or one global shock could send the entire system spiraling. For dealerships, it's survival mode. For buyers, it's a high-stakes gamble. And for automakers, it's a test of how far they can bend before something finally breaks. If the market finally cracks wide open, the aftermath will not be pretty. Dealerships that are already on the edge will likely close their doors for good. The survivors will be those with enough financial cushion to weather months of losses, but smaller family-owned stores, the kind that have been community fixtures for generations, may not make it. Once they're gone, they won't come back, and that could permanently change the car-buying landscape in many parts of the country. For automakers, the aftermath could mean a brutal reset. They may be forced to abandon ambitious expansion plans, cancel certain models, and scale back production to levels not seen in years. Plants could go idle. Tens of thousands of workers could face layoffs, and suppliers, companies that make the parts, electronics, and materials, would feel the pain just as sharply. A slowdown at that scale doesn't just hurt the auto industry, it ripples across steel, plastics, electronics, and even shipping industries tied to moving vehicles around the globe. Buyers, on the other hand, could find themselves in an unusual position of power. With dealerships desperate and automakers cutting to survive, consumers could score the kinds of deals that seemed impossible just a few years ago. But this comes with risks too. Fewer dealership service centers, limited model options, and the possibility of longer wait times if production lines slow down too much. Essentially, buyers may win on price, but lose on convenience, choice, and long-term stability. And this isn't just a US issue. The global auto market is deeply interconnected. If American dealerships collapse and automakers scale back, countries that rely on US demand for vehicles or parts will feel the ripple effects. Factories overseas may shut down, shipping lanes may quiet, and international automakers could rethink their strategies entirely. What looks like a dealership crisis in one country could turn into a worldwide auto recession. One of the most lasting effects of this crisis could be the way it reshapes buyer behavior. Already, people are questioning whether owning a brand new vehicle is worth the financial strain. Many are stretching out the life of their current cars, investing in repairs instead of trading in. If this trend sticks, the auto industry could face a permanent decline in new vehicle demand, with more consumers turning to used cars, certified pre-owned programs, or even ride-sharing as alternatives. Subscription-based ownership models are also starting to gain attention. Instead of locking themselves into long-term loans with sky-high monthly payments, some buyers are considering monthly subscription services where they can swap vehicles as needed. Automakers love the idea because it creates recurring revenue, but buyers may see it as a way to avoid the risks of depreciation and uncertain resale value. If dealerships continue to collapse, these subscription and direct-to-consumer models could grow much faster than anyone expected. The crisis is also creating hesitation around electric vehicles. EVs were already a hard sell for many buyers due to high prices, limited charging infrastructure, and questions about battery life. Now, with dealerships overloaded and discounts hitting both gas-powered and electric cars, buyers are becoming cautious about investing in technology that may lose value even faster than traditional vehicles. Automakers that bet big on EV rollouts could face a painful reality if consumer adoption slows down during this market reset. And let's not forget the cultural shift at play. For decades, owning a new car was a symbol of success, independence, and stability. But today's buyers, especially younger generations, see cars more as tools than status symbols. They're less willing to go deep into debt for a brand new vehicle, and that shift in mindset could permanently reduce demand. The crisis may simply accelerate a trend that was already underway, pushing automakers to rethink how they market cars and what role personal vehicle ownership will play in the future. To survive, dealerships are being forced to get creative in ways they never imagined a few years ago. Some are aggressively shifting toward online-first sales models, where the entire buying process, from financing to delivery, is handled virtually. They know buyers hate the haggling game, so they're experimenting with no-hassle pricing and digital transparency to rebuild trust. Others are trying to sweeten the deal by bundling service perks, free maintenance packages, extended warranties, or lifetime oil changes just to lure buyers through the doors. Mergers and consolidation are also becoming a lifeline. Smaller, family-owned dealerships that can't shoulder the crushing costs of floor plan financing are being bought up by larger dealer groups. These mega dealers have the resources to weather long downturns, but their dominance could reshape the landscape. Fewer players in the market often means less competition, and eventually, that could mean fewer deals for buyers. What feels like a buyer's paradise right now could, in the long run, turn into a much tighter market. Another survival tactic we're starting to see is diversification. Some dealerships are dipping into used car superstores, others are focusing heavily on certified pre-owned programs, and a few are even expanding into rental fleets or subscription models of their own. By spreading out their business, they're less dependent on the unpredictable flow of new vehicle sales. It's a risky pivot, but for many, it's the only way to stay alive while waiting for the market to stabilize. But even with all these strategies, the underlying problem remains. The balance between supply, demand, and affordability is broken. As long as interest rates stay high and consumer confidence stays low, every dealership is just buying time. The question is, who has enough fuel left in the tank to outlast this storm and who's running on empty?